Hello, I'm Michelle Makori, and this is Kitco News. U.S. inflation hit a 40-year high in June of 2022 at 9.1%, and it has been easing since, cooling down for the seventh straight month, with January CPI coming in at 6.4% year over year. Well, my next guest says we have not hit peak inflation, and he expects to see CPI back up between 8 and 12% by the end of this year. Michael Wilkerson is the founder of Stormwall Advisors and the author of the recently published Why America Matters, a Case for a New Exceptionalism. Michael has 3 decades of experience as an emerging markets investor, M&A expert, and business leader, including as a managing director for Lazard, one of the world's top M&A firms. And he is also the chairman of Charity Water, a nonprofit helping to resolve the global water crisis. Michael, good to have you back on Kitco.
Michelle, great to be back with you.
So, Michael, inflation has been cooling, but you're saying let's not get excited yet because you're actually anticipating that inflation heats right back up to between 8 and 12% by the end of 2023. Again, it has been trending down since the peak in June of last year. The most recent number from January shows inflation at 6.4% year over year, as I just mentioned. And the consensus is that we've probably hit peak inflation, with the Fed seemingly committed to stay the course with aggressive rate hikes. So what happens to get inflation between 8 and 12% by the end of this year? Break that down for us.
Thank you. Well, first of all, I'll say that I know that I'm the minority report on this. I'm getting used to it. I started to talk about the risk of looming inflation in 2020 when it was definitely fringe. At least now it's in the mainstream because Americans and people around the world are living it. What I have said is that I don't believe that we've seen the end of inflation, that I do think that we're going to see another spike up, turn up. And whether it's 8, 10, 12, of course, I have no idea, nor can I say precisely by the end of 2023. But I do believe that it is possible that we find ourselves back in that range this year in 2023. Why do I say that? Well, first, a little history. When you look at the history of, at least in the 20th century, of inflations, the big ones in Europe and in the US, what you see is that inflation doesn't move in a linear path. You do see this cycling up, down, up, down. That's the first point. And I think we've seen some relief for some specific reasons. You mentioned that inflation in January was 6.4, down from 9.1 in June. Step in the right direction, still too high. If you look at it on a compound basis over the last 2 years, Americans have lost around 14, 15% of their purchasing power. And by the way, that's, of course, if you believe CPI is an accurate reflection of what people are experiencing, which we don't.
That's a whole other conversation, but let's assume that it is, because that's the data that you're citing will hit 8 to 12%. So let's work off that premise.
So if you move beyond that to what is really driving inflation, it, of course, has been energy. It's true in Europe. It's true here. We've seen double-digit rises in energy prices across the board, overall energy. Now it's starting to come down again, where you saw energy in January, 8.7%, et cetera. But other factors, and even food coming down as a result. Other factors, I just wrote a big piece on electricity, that we've had double-digit 16% electricity in the past year, and that's going to get worse. So why do I think it's going to persist? Well, there's some specific factors, or things like electricity, that we know that many of the regional power companies have put in applications through the regulator to increase prices this coming year by anywhere between 15 and 20%, depending on the region. PG&E, Florida Power and Light, Georgia Power, all across the nation. Why? In order to recoup some of the fuel costs that we saw spike last year. Natural gas went up and came back down. Coal prices tripled during 2022. So there is a specific reason, but that's actually not the argument I'm making. The argument I'm making is, if you think about all of the reasons we were given, whether by government officially or in the media, about what caused inflation, it was everything from Putin's price hike to COVID, unlocking of the economy. There's some truth to that, to be sure. Greedy farmers, greedy truckers, greedy oil companies. When you cut through all of that, you hear everything except the actual reason. What is the actual cause of inflation? It's always government. It's always government printing money. So my argument is as follows. If you look at what's happened since the global financial crisis, we have had a tripling of the US dollar money supply, M2 basis, from just over 7 trillion to 22 trillion at the end of 21 trillion at the end of 2022. Now, by the way, that money supply increased by 40% just from the year 2000. You cannot, and you've never had a time in history where the money supply increases by that much without it resulting in inflation. And again, if you look at that same history, at least of the data we have from the 20th century, inflation, price inflation always catches up with money supply inflation. It may not be 100%, could be 60%, it could be 80%, but it always gets there. Now, part of this, of course, these are facts that are known to everyone. We've increased the national debt to 31 trillion. We've got 19 trillion of cumulative deficits since 2001. By themselves, debt doesn't cause inflation. Deficits don't cause inflation. But when you increase the money supply beyond demand, beyond aggregate demand, in order to supply that debt to fuel those deficits, that's where you run into problems. The big takeaway here is that price inflations lag the money supply inflation, and oftentimes by several years. So part of the argument I'm making here is we've got a great big catch up to do on money supply inflation, and sooner or later it will be reflected in prices. That is the nut of the argument here, is that until we see an equilibrium between this increase in the money supply and what you'd call unrealized inflation, the lag in prices, whether it comes this year or it comes next year, we will have to reconcile those two things, unless, of course, the velocity of money shifts fundamentally. We've not seen that. And what causes the lag, of course, is this very slow delay in or tamping down of velocity. We're still at a very low level of money velocity compared with pre-lockdown eras.
Okay, so I get your argument that we have really inflated the money supply drastically. And I get your point that up until now, politicians would have us believe that it's anything but the money supply, that it's anything but this unprecedented fiscal and monetary stimulus, blaming inflation on, as you say, COVID, China, global supply chains, then Putin. And you are correct in asserting that the M2 money supply has risen 40% since 2020, but recent quantitative tightening and Fed rate hikes seem to be working. I mean, the Fed has recognized this, admittedly well behind the curve, too late, but it has recognized this and has been working to drain this excess liquidity. And in fact, M2 has gone down from a peak of 21.7 trillion in March of 2022 to 21.2 trillion in December. Okay, perhaps not enough, but the trend is there. We also know that the Fed has been reducing its balance sheet. So assuming that this trend continues, wouldn't you expect there to be less inflation if the Fed does remain dedicated to bringing inflation down? And Powell, if we are to take him at his word, which is a whole other matter, but he has said that the Fed will keep at it until the job is done. So if the trend that we're seeing from the Fed is to really tackle this, why do you think it's going to go the other way if the primary argument is that it's mostly based on money supply?
So you just mentioned the reduction over the last few months, about $500 billion, a little less than that. Keep in mind, the increase was $14 trillion, 14 trillion. They do not have the ability to significantly reduce it much further. Can they keep chipping away at it? Possibly. You also mentioned the Fed's balance sheet. It's come down by about 300 billion from, I think it was 8.9 to 8.6 at the end of December. Again, it went up from 0.9 billion in 2007. So in other words, it went up by 8 billion, and now we're 8 trillion, and now we're doing victory laps because we've cut off 300 billion. It's not going to be enough.
Okay, so too little, too late.
Too little, too late. They'll run out of ability to do much more. Keep in mind that absolutely the numbers spiked incredibly because of pandemic relief, everything else. We had 2 years where we ran $6 trillion in deficits over 2 years compared to 19 trillion that we've accumulated over 23. So of course there was going to be some slackening, some tightening. It's not going to be enough. The other point you mentioned, and I do believe, obviously, the Fed is taking action. We've seen the steps that they've taken to, what was it, 8 step-ups in the inflation rate. So the Fed is now targeting somewhere between 4.5, 4.75. The market has the terminal rate at 5.3 right now. By July, the language remains hawkish. I argue that talk is tough, but the Fed is going to run out of firepower, and the cost and consequences of continuing to raise rates is going to be too high. In other words, this always becomes a trade-off ultimately between tamping down on inflation, slaying the inflationary dragon, and allowing recession and unemployment to rise. And governments always and everywhere, when faced with that terrible Hobson's choice, terrible trade-off between two unattractive options, always and everywhere choose inflation, because the consequence of the social unrest, of the political unrest that occurs when you err to the other side to allow unemployment to rise, allow a recession to take hold, is just too great. The government, therefore, has multiple motivations. One, it's the lesser of two evils. But secondly, of course, as the government is the biggest debtor in the economy, it benefits from inflation. You know this, but I'm just to reiterate, inflation is a tax. It's a hidden tax. It doesn't destroy wealth. It just moves it from one pocket to the other. It moves it to the pocket of governments ultimately and out of citizens. So you will hear everything but this being said, but the real motivation will be to allow inflation to run as an alternative to recession and rising unemployment.
A couple of points that I want to bring up there, Michael, is firstly, we have somewhat adjusted to the idea that perhaps a 2% target is not going to happen, and that there will be a new normal. Mohamed El-Arian, he warned recently that the Fed cannot achieve its inflation target of 2% without crushing the economy, and says you need a higher stable inflation rate of 3 to 4%. Some people are saying expect the new normal to be 3 to 4, 3 to 4.5, maybe even 3 to 5. But you're predicting an even higher inflation possibly than the one we saw in June of 2022. So, and markets have already sort of come to terms largely with the idea that there will be a recession to a degree. So that's sort of baked into expectations on Wall Street and on Main Street. So again, what is the trigger that's all of a sudden going to exacerbate this problem so drastically and so dramatically that we potentially exceed that peak hit in June of last year, especially when there is a willingness, if you will, or an acceptance of the reality that we will be weathering some kind of a recession?
Yeah, so absolutely. And I think, by the way, that the 3 to 4 bound, if we could maintain that is the best possible outcome. I'm not saying that's out of the question. I look at it and I think it's unlikely. We've talked about some of the reasons why. That is, in my view, a perfect landing of the inflation situation. Absolutely no one, to my knowledge, no one is saying we can get back to 2% anytime in the medium term. Could we run at 3 or 4%? It's possible. That is the best of all outcomes that I see, just looking at the factors, the data that we've been talking about. So I think seeing something, and the other point, Michelle, just to mention, is interesting study that was done last fall by Deutsche Bank that showed, once you've entered that 8% zone for any sustained period of time, even a few months, looking at all the data that's available from the 20th century, it's very unlikely that you can keep inflation down below that 8% level for very long, that it takes several years to work it out back down to, let's call whatever the normal level might be. And yes, as I mentioned at the beginning, it's not a linear path. You do have these easings and tightenings of inflation. That's not the right term, but you know what I mean, lowering of prices and then spiraling back up to a higher level than what was set before. When I look at things like, again, now moving slightly away from CPI, what's happening in the electricity markets, what's happening in food, I just don't see it easing in that sense. We have a conflict situation in Europe that isn't getting better, it's getting worse. Right. And what I haven't mentioned, I think this is, let's say, swings it a bit in the direction of higher inflation, is China is reopening. This is going to be a massive swing in terms of actual supply-demand relationships. At the same time, that supply chains really haven't readjusted. In fact, what we're seeing in supply chains coming out of lockdowns and all the lessons learned through both the pandemic and the conflict in Ukraine is that every nation around the world is rethinking their supply chains, bringing reshoring, bringing things back online. That creates inflationary pressure. So you have this correction to the supply chain, localization, reshoring one, and China's reopening. These are massive factors, in my view, that tilt it towards a higher inflation scenario.
But is there a particular trigger? Is there a particular inflection point that it becomes clear, or that needs to happen, where it becomes clear that inflation is just not going to be tamed in the way that the Fed and largely the markets are expecting?
Well, like a lot of things in life, it'll happen slowly and then suddenly, right? We'll see it in some data, as we did in January. By the way, across
so it's not a matter of a Fed pause or a Fed pivot. That's not what you're thinking.
I don't think so. What I was going to say is you are seeing already in Europe in January, the inflation numbers turned up again. Almost everywhere was above expectations for January, going the wrong direction. The U.S. was slightly above, couple points, significant. But typically, often, not always, what happens is there is some extraordinary event, some like what happened in February last year. Before February of 2022, inflation was running hotter in the U.S. than it was in Europe. The war, the invasion, and I should say sanctions, tripped the line where all of a sudden European inflation spiked. And for the last year, Europe's been running hotter than the U.S., clocking in at 10% inflation compared to the U.S.'s 6%. So I say that to say things happen. Sudden events can happen, shifts in supply lines, energy crisis. We're still in the midst of it. Europe's still in the midst of it. So I could imagine a scenario where it isn't some slow drip, but rather we get into another situation where we get a surprise, a negative surprise, that triggers a rise again, in addition to the other factors that I mentioned before. I don't know that it's a specific Fed plus 25 minus 25 issue. In part, the markets are disregarding it. We've seen that we continue to be in this everything bubble. Valuations are way too high. If you look at, let's take the Shiller PE, sort of the traditional conservative value view. Today, in February, we're still at 29 times earnings compared to, even if you look at the since 2000 era of high valuations, where the median was around 26 times earnings. So things are still running hot. Just a final point on the inflation is you look at what's happening in labor markets, in wages and elsewhere, the economy is still running very hot, very tight. So I think there's pressures. I go back to my original monetary view as to the underlying issues. Mm-hmm. There are specific factors like the fact that our economy is running hot. Labor wage spiral is a real threat. China reopening, et cetera.
All right, well, let's talk about the labor market, because that is perhaps one of the positives that many analysts are saying could in fact usher in a soft landing, that you could have this Goldilocks scenario, that there's still hope because you have an unemployment rate at 3.4%. That's the lowest since May of 1969, according to the latest jobs report. But at the same time, there are a record number of job openings, which increased to 11 million as of December. So the hope is that there'll be an elimination of those open vacancies rather than an elimination of existing jobs. And that sort of helps the recession argument. What's your take there? Of course, that has implications for inflation as well, but what's your take on that scenario?
Well, the first thing I'd like to caveat the whole discussion with a quote attributed to Winston Churchill, who either said or didn't say, "I don't trust any statistics except the ones that I doctored myself." And I think this is the moment to bring that into the discussion.
I mean, there's that expression, Michael, 86% of all statistics are inaccurate.
Including this one, right?
Exactly, yeah. Go on.
We kind of skipped over the issues with CPI, but I am troubled by the conflicting data that I see in the labor markets, employment markets, the information coming out of government as opposed to private sector, payroll agencies, credit bureaus. It's confusing. It doesn't line up. I'm not an expert on this issue, but I when I see these kind of gaps and distortions, if someone loses a job, and they get two part-time jobs back that are paying combined 80% of what they were making before, have jobs gone up? Is their lifestyle any better? They're actually worse off. How do you measure these things? I think, the point that you just made, very low official unemployment and job openings, you could read it two ways. You could read it the way you said it, which is that, okay, maybe this allows for a soft landing with, recessionary pressures. On the other hand, you could go to what I was saying, which is the potential for this labor wage spiral, which is to say, we can read it as it is, which is the lowest unemployment ever, that jobs the market is still very tight. Labor market is tight. Companies are finding hard time with qualified positions. Now, on the other hand, contradiction would be, these big layoffs we're seeing in corporations, first in tech last year with 160,000 layoffs, now spreading to other parts of the economy. I think that was excess supply of labor, to be honest, that needed to come off. Those markets were cooling. Tech was obviously needed to contract a bit. I don't think that's an accurate reflection. So I'm not convinced that what we're seeing in the labor markets isn't actually putting further inflationary pressures on the economy in 2023. Okay,
so let's assume that you are correct, and let's assume that we find ourselves in December of 2023 with, and I'll take the midpoint of your estimate, a 10% CPI number, right? 10% increase year over year from previous December. Not a very happy Christmas. What does that mean for the economy? What does that look like in terms of the real impact of people in the economy, and both for Main Street and separately we'll get to Wall Street, but what does that mean for an economic picture then?
Well, let's talk about Main Street first, because I think that's where the consequences are really bad. If you look at what's happening with the consumer, what are we seeing? So we're seeing rising credit card balances. We're seeing depletion of savings accounts that were stuffed and puffed during 2000 with pandemic relief and other things, and the fact that they couldn't spend money. But that savings are going, credit cards are getting loaded up, delinquencies are rising. Now, at the same time, you saw the consumer spending in January above expectations, which was a little bit odd. Could be the last hurrah here. But the reality is that when you look at things that people are spending money on, food, gas, electricity, those are all double-digit increases in this. Shelter also has been up. Transportation. These are all numbers that are well above the CPI statistic. So what happens to working class families, middle class families, when already they're down in purchasing power, call it 15% last 2 years in the things that they buy every day? It's worse than that. And you double down on it this year in 2023 with another 10, 15%. It's very, very bad. And this is, of course, then the tension with recession. Could that imply then stagflation, where we get into this monetary inflation loop where prices are still rising, and yet then the economy is going into recession and rising unemployment, the misery index spikes, we get a return to 70s style stagflation. That, I argue, is a real possibility here. Wall Street, unless you want to comment on the Main Street side, I'll move on.
Okay, but let's unpack a little bit about Main Street before we get more of your thoughts on the stagflation that you are saying could likely happen in this scenario. I know that you have, this is perhaps not so much a Main Street type of index, but I know that you have been documenting, the rising cost of water, perhaps because you're involved in a water charity, that you have a particular interest in rising costs of water, mineral water and such. So why don't you break that down for us? And again, that doesn't necessarily apply to the average household who may not be buying mineral or sparkling water, but break that down for us and then further expand on, again, what this means if there is a stagflation. What kind of recession are you expecting, deep or shallow? But let's look at those water stats you have.
Well, just to comment, if you live in East Palestine or you live in any of the many other places in America where the water is not actually safe, the price of water does matter. It matters quite a bit. It's not okay, fine. We can talk about an elitist inflation index of imported sparkling water being up 73% in the last 3 years, if you can find it these days. But if you just look at all bottled water based on the Fed's data, price of water has gone up by 35% since January 2020. 35%, okay? Now, there's been a lot of talk about eggs, how the price of eggs has spiked if you can find them. $10 a dozen. I've seen that in my own local grocery store here. There were some specific reasons that people blame that on. What is water? Water is water. It's the packaging, the plastic, glass, can, and it's the transportation. Let's presume the water hasn't gone up. So there's something underlying either in the packaging or transportation, all of which goes back to energy. So a lot of this is clearly driven by energy. But if you look at 35% on something that is a basic necessity, again, belies the underlying CPI data that says that, oh, this is not an issue, it's a single digit and coming down. Even basic, domestic LaCroix, which a lot of people drink, both for health and other benefits, up 67% over this time. So, and I think, not to exaggerate, East Palestine as being an issue for the rest of the country, but this just gives an example. If you are dependent on an alternative source of water, even the most basic human essentials has now been priced up by a third since the start of lockdowns and the pandemic.
Yep, that's a very valid point. And I do want to get your thoughts on East Palestine a little bit later on in the show. Let's focus further on the recession that you are anticipating then. If we have a 10% CPI data number coming in at, say, like December of 2023, what does it mean for a recession? Are you anticipating a deep and prolonged recession, or does this go away quickly as it comes? What's your outlook there?
Well, I have to say I was more tilted towards seeing worse recession sooner a month ago than I am today. Why is that? It's some of the things that we've been talking about, surprisingly strong data coming out of labor and employment markets. Consumer sentiment is weak, but confidence is increasing. PMI today came out showing a surprising rebound, although on the other side, home building market was still very low. So we're getting all these conflicting data. So I think a month ago, I said that I thought that we would see it in the first quarter or the second at the latest. I'm not sure that's true. I think we're going to still see growth in the first quarter. It could still happen in the second. But I think now it's looking more likely that it's going to be pushed out another quarter or two. I do believe it's coming, especially if you listen to those on the front line, CEOs of public companies and otherwise. They're describing what they're seeing as the market environment. We know they're having a very difficult time driving volumes. Their margins are getting compressed. They're getting some pricing gains, but they're seeing the consumer trading down. So they're talking a lot about weaknesses they see in the economy. In my mind, what they're channeling to the market is probably one of those important things because they're signaling where we're likely to go. The market itself, the stock market, hasn't reacted. So even though we've got earnings expectations coming down, as we talked about, PE ratio is still pretty high. So to answer your question, looks like it's back-ended second half of 2023. I am optimistic about the strength of the American economy. So I tend to think it's more V-like because of the resilience, because of the ability, the flexibility within the economy to react. I am concerned about some of the regulatory overburden, which seems to be increasing. You can look at sectors like energy, like crypto as another example where we seem to be going in the wrong direction on bureaucratic red tape and regulatory overreach. Nonetheless, that would be the barrier, I think, to a V-shaped recovery is if we get in our own way.
All right. So firstly, on the V-shaped recovery, when do you see the V ascending back up?
Well, if it's a V, then it's presumably within 2 quarters of the downturn. So, I'll stick with the technical definition of recession. Let's assume that we have the 2 quarters of negative GDP in a more substantive way than we saw in the first half of 2022, which I would argue was technical, but not deep. I think, in my view, if it happens this year in the second half, it will be deeper and more substantive. But I think what I mean by V is by the third quarter, we're moving back in a positive direction again, that we don't see more than 2 quarters of negative GDP.
So we'll move into a positive direction with regards to economic growth, but at the same time, or maybe perhaps because of it, we're going to have inflation accelerating up to 10% or 8 between 8 and 12%, as you said.
And this is the stagflation issue. So what I'm describing here is, let's call it my major, my minor. My major is inflation. That I think this is a certainty. But
you're saying stagflation would imply increasing inflation, reduced economic growth. You're saying that at the same time that we'll have inflation spiking,
exactly.
we'll have the economy growing.
No. So what I'm saying here, again, second half of 2023, recession in both periods. So negative growth at the same time that inflation is picking up steam. So that's the stagflation. That's the one that runs against the sort of traditional trade-off, Phillips curve trade-off between inflation and recession, that in the back half of the year, we are, unfortunately, and that's why they call it the misery index, seeing both numbers rise at the same time, a return to inflation and weakening the economy, a rising unemployment level.
So again, back to my earlier question, when do you see the trend reverse? If it's a V shape, it's got to go up afterwards. When do you see that happening?
That implies 2024. So if you see this weakness in the second half of 2023, the recovery is 2024. I don't see it extending a terribly long time beyond that. I think 2023 is going to be tough. I'm hoping that it will be the bottom. Now, again, I pushed back the bottom from being the second quarter to third, but by 2024, I'm as confident as one can be about next year, which shouldn't ever be very. And we may talk again in 3 months with a very different view. But I would, if I had to look forward, I'd say 2024 is the year of recovery.
Whilst you still have that persistently high inflation going into the beginning of 2024.
You know, the thing is that you can have economies moving with a certain level of inflation. Even that kind of 8-10% number is not inconsistent with economic growth. In fact, in some times and places, it's pro-growth. It's, again, terrible on certain classes in society, certain classes in the economy, for the overall economy, for both the real economy and for asset markets. It could be not as terrible as it is felt in the pocketbooks of a lot of people struggling. Right. See labor, see their earnings keep up with inflation. So
let's bring it back to Wall Street and the markets then, because the markets have been resilient so far. The S&P 500 up about 4.5% year to date. What would that mean for the markets if we do get this inflation between 8 and 12% by the end of the year? What do you expect to see in terms of market performance? So historically, again, equities have done pretty well in inflations. Haven't kept up 100%, but they have kept up 60-70% with a rise in the price in the price index. Certainly do better than bonds, fixed income generally. Certainly do better than cash. If you look at the typical inflation hedges, whether it be gold or commodities, real estate, stocks, equities have done well. So I think we're seeing asset inflation in the sense that all of that money supply increase that we discussed earlier first translated into asset prices before it translated into real prices in the real economy. We saw it with the dramatic rise in all kinds of asset classes, which you're familiar with. So I don't see that kind of inflation as being inconsistent with the market continuing to perform at these high levels. We can get into details around what sectors and what have you. But I'm saying two things. One is that, of course, if we talked about some sort of big cataclysmic break, all bets are off, because the market, while it's been strong, I think is on a bed of fragility. And you could see something very disruptive, the equivalent of what happened in February 2022, and all bets are off, and we're going in a different direction. But assuming that doesn't happen, and yet we still have this rising inflation, even look at what's happened in the markets this year when we were in the midst of higher inflation all the way through. The market has more or less ignored it and moved in a different direction, not always up with inflation, not always down when it was down, but has moved consistently. I do think that what matters in this environment is the sectors. And there's some sectors that I really like right now, some sectors that I really don't. And a lot of it goes back to this inflationary view. All right, so let's break that down. And of course, the Feb 2022 incident that you're referring to is Russia's invasion of Ukraine. And you're saying, barring any kind of tremendously volatile geopolitical escalation or any kind of black swan event, that you think that it's quite likely that we have inflation at, say, 10% by the fourth quarter of 2023, but markets continue to do well. So you're not necessarily anticipating a drop-off in the markets.
Well, I would say both things are a possibility. I don't know that I would say very likely. I want to hedge it a bit and say that I think it's a possibility. I think it's even likely. very likely is too strong for me, both in terms of hitting 10% inflation. I will say I think it's a probability. And what I will say is I think there's also a probability that the markets continue to float along with that, especially in commodities, especially in dividend-paying, value-playing opportunities.
So let's break down the sectors that you're bullish on then, and how investors should be positioning themselves for this kind of scenario.
I continue to be bullish oil. So I made some good investments in the 2020 to 2022 period. I made some bad investments, but one of the best ones that I made was really going hard and long on oil. Look, going back to 2020 when Exxon, one of my favorites, was trading at $40 a share or below. Now at 120, maybe a little bit less than that today. So tripled over that time. I do not believe the oil boom is done. Again, go back to China reopening is probably one of the biggest drivers, combined with this continued global supply chain disruption of energy markets generally. So anyone like Exxon in the exploration production side, some names in exploration and gas like Chesapeake are also very attractive with a very high double-digit dividend yields and low multiples. In this environment, I like things that are going to do well in inflation. In other words, that have the best probability of keeping up with inflation, where their ability to move up prices doesn't lag by a year. So think about, and by the way, here's another related category, is I like the miners across all strategic metals and even things like coal. Why is that? Well, they're trading at very low multiples, very high dividends. It's interesting because so much of the institutional market, investing market, has been taken out by ESG policies that prohibit investing in coal, in oil, and all these other things. That isn't great for the industry, isn't great for future production. It's pretty good for investors who can take a look at names like Rio, like Vale, BHP, and others that have those attributes of high dividends. You get some volatility, of course, but the multiples are so low right now at 4 or 5 times earnings. And again, double-digit dividend yields. From my perspective, it's hard to pass up. Okay,
so you're very bullish on the energy sector. What else do you think does a good job of hedging or protecting one's portfolio in the scenario that you're saying is within the realms of probability?
So oil and gas, so all strategic mining, which covers a lot of different things. I also still, I'm very picky on real estate right now. I think there's some terrible markets and I think there's some great markets. If you look at demographics in places like Texas and Florida, I think we're still going to see a lot of growth in those markets. Elsewhere, probably not so much. I actually think now I've been bullish gold since 2020. I've been wrong for 3 years. So as I said, I got some things wrong, probably with like a lot of people who are watching your programming and Kitco generally. I think it's inevitable, whether it happens this year or not, but I will continue to remain bullish on gold because of, well, the underlying view on inflation, because of the supply-demand properties, absolutely. Next, I would say that I think core crypto has potential this year to rebound from, of course, a very terrible 2022. There are the underlying fundamentals of what is going on in the space in terms of development and use case. One, coming off a terrible year of frauds and scams and otherwise. What will make that not true is if we see a continuation of what we've seen in the last 2 months of this very strong regulatory grab from the Federal Reserve in terms of declaring that crypto assets are not bankable assets, and the enforcement actions we're seeing from the SEC against stable coins and others. That's the contra view. But barring that and barring that continued expansion, I think crypto should perform well this year. When I say crypto, I'm talking about the Bitcoin and Ethereum, not a lot of the other altcoins that that have sprung up.
Okay, let's go back to some of the specifics there. You're bullish on gold. Do you think gold makes a new all-time high in 2023?
I actually do. And, on this one, I've had to learn by painful experience, just because I believe it doesn't make it true. As saying goes, occasionally wrong, but never in doubt. And I was very confident on gold in 2020 and very wrong. And
2022.
Sorry, no, all the way back to 2020. So I really started going long and hard on beginning in 2020. And then, of course, we saw it start to crumble then. So I've remained bullish through 2022. We haven't seen the movements that we had. Now, part of this, and the other thing that I got wrong, was not appreciating how much the US dollar was going to appreciate in 2021 and 2022. I think that had a factor in tempering the price of gold as the US dollar moved against it. I also think, and I don't want to get too much into tinfoil hat territory here, but what I see going on, or what appears to be going on in the banking market around the derivatives, we've got, what is it, 860 billion of gold derivatives notional value outstanding right now, and a very small number of dealers. And I just have a smell, and nothing more than that, that there's something going on here that is akin to what we saw going on in the mortgage-backed securities market in the mid-2000s and with LIBOR in 2011. What do I mean by that? That we're not getting price transparency here, and when we do, we will see movement to the upside. When and what causes that to break or change, I don't know. But these kinds of things don't last forever.
You're certainly not the first person on Kitco News to say that something could be amiss with the derivative markets, especially as it pertains to gold and silver, that there could very much, in fact, be some manipulation there, and that there could be more paper gold than real gold in the market. But again, that's a conversation that we've had with other guests, and I understand that you don't have any hard evidence to substantiate that. You're saying it's just a sense, if you will.
Just a sense. It's 30 years of experience in business and on Wall Street. It's having read a lot of financial markets history, and all of that sort of being rolled up into a sense of smell. And intuition is probably not the right word, but you're right. It's not data that I've seen or can see. But over time, you begin to recognize patterns, and you begin to recognize that certain things, when they look a certain way, there's something there.
Michael, then I always ask investors, why invest in gold if you believe that it could be manipulated?
Well, and I said it to a degree that these things can't go on forever. Now, that doesn't help us this year. I do believe that, oddly enough, we're in this very interesting period of greater transparency, and all the things that have been coming out recently about some of the and I don't want to get into this, and you don't either, Twitter file revelations about various collusions and things like that. Why do I make that point? Because I think that, the collusive activities that go on cannot go on and do not go on forever. And I think it's become increasingly true in recent years that at some point these, fraud may be too strong of a word, but this sort of manipulation or collusion, it just cannot persist. The weight of it eventually is too much to bear.
Well, I think that's a valid point that you make, that with Elon Musk taking over Twitter and releasing the Twitter files, a lot of so-called conspiracy theories have proven to be accurate and substantiated by a number of those tweets, at least with regards to a collusion between certain parties like the deep state, the FBI. I mean, that's at least what the Twitter files would indicate. So I get your point there, that if that sort of comes to the surface at some point, the other elements that could be suppressing something like the price of gold could at some point come to the surface. And that's why you're still a long-term gold investor. You mentioned the dollar. And of course, a big question is, if we have inflation at around 10% or even back up to 8%, what does that mean for the dollar?
It may mean nothing. And here's why I say that. Obviously, when you enter into a zone of hyperinflation, what happens to the currency is pretty clear. But we could continue to see the kind of strong dollar that we've seen, even in the face of rising inflation in that zone. What will it depend on? It will depend on what's inflation like in Europe, what's inflation like on other parts of the world. I believe you've had guests talk about the dollar and the dollar milkshake theory and other issues that surround it. So I have no confidence that 10% inflation means one direction or the other for the dollar. There's so many other things going on right now that I don't think it's determinative. Okay,
well, what would 10% inflation and the dollar mean for gold then?
So 10% inflation should be very positive, should be very bullish for gold. Now, that was also true over the last couple of years, and yet it didn't manifest. Why did it not manifest? Well, we talked about the strength of the US dollar melting up, which I think suppressed the price of gold in dollar terms. Secondly, we talked about potential factors that are inhibiting price discovery of the natural market price of gold because of this derivative market activity.
Right.
But if we put those two things aside, which could or may not continue, 10% inflation is very bullish for gold. In fact, it should be one of the best performing assets in this environment.
Michael, you did mention miners and resource miners. Do you have any particular picks that you're looking at there?
I have been very positive on Rio Tinto, Vale. I think some of the junior miners as well. But in particular, I'm looking again at diversity, both geographic and product. I'm looking at then the financials around dividends, dividend yields, multiples, any big issues that could take them out. But I like diversity, especially as a big driver, because you never know what's going to happen with one product. You never know what's going to happen in one geography. So, but those are two names that have been on my list.
Okay, I want to touch on the point that you made about institutional investors backing away from big oil companies, big miners, because of ESG narratives, which, as you say, on the one hand, makes it a cheaper or a good buying opportunity for retail investors. But wouldn't you ultimately need that institutional money to come back in there to really pop the stock price?
You do, if that's what you need. So think of it this way. These companies, so let's describe a couple of different factors. First of all, I think this ESG-driven prohibition on financing of energy projects, mining projects is horrible. It's horrible long-term because you can't get financing of project-level debt. And that is a problem for the industry, absolutely. So it's a terrible thing for the industry. As an investor, if I'm getting a 10 or more % dividend, I don't necessarily need the stock to pop. I just need continuity of those dividends, and I will eat those dividends all day forever and be happy. I don't think it's good for the companies because it's not just where, they're fully financed from an equity perspective and they're throwing off plenty of cash, but their model requires that they have project financing, debt financing. A lot of that comes from historically from the big banks and from some government and agencies that live between the public and private sector in regions around the world. And if that starts to get squeezed, which it is, I think that is a long-term issue for the industry in the West, because in places like China and places like India and other parts of the world, it's not a factor. So this is getting into more of a geostrategic issue around is the West, Europe, the US, going to continue to not just survive, but thrive in the energy sector, or are we going to give up ground because we are unable to fund new project development in these important sectors of our economy?
Well, it seems as though the political agenda is to give up ground. If you look at what many are calling the war on domestic oil and gas production.
I agree 100%. And this is the tragedy. I know you've spoken on it. I've spoken on it a lot. We cannot continue to go down this path. We are now, take the U.S. Refinery capacity. It's not that we don't have the production capacity, but during lockdowns, during that period, capacity was taken offline. We're now at our lowest refining capacity. I believe it's 17.9 million barrels per day, the lowest level in 10 years since 2014. This is not sustainable. And right now, the regulatory and bureaucratic process means that there will be no new refineries brought online. That's one example. We could go on and probably name a couple of dozen issues.
Michael, you did mention the situation in Ohio's East Palestine. And as we discussed, you are, in fact, the chairman of an international water charity. So I'd like to get your thoughts on the situation there. Just as a recap, February 3rd, we had a train derailment in East Palestine, which released hazardous materials like phosgene and hydrogen chloride into the air, potentially contaminating water sources. Now, keeping in mind that 10% of the American population, in fact, lives along the Ohio River Basin, so we're not even sure how far this tragedy could extend to. But what are your thoughts on this? Just how severe do you think the situation is there in East Palestine?
Well, first of all, I feel terrible for the residents of East Palestine and all the areas affected. I saw some of the video clips of people poking sticks in rivers and creeks and seeing this noxious chemical elements coming up, complaining about their home still smelling, being dizzy and everything else. It's horrible to see what's going on. What has really disturbed me has been the level of blame shifting coming out of senior officials in the Biden administration. and trying to place blame elsewhere, shifting responsibility. This is not the moment for that. This is a time to do something else. But here's a deeper issue, Michelle, that I just want to point out. This same administration in January of 2021 put a gun to the head of Keystone XL, okay? Because ostensibly because it wasn't good for the environment, it wasn't safe. And yet it turns out that pipelines, and now I'm talking in particular about oil and gas, it doesn't work for chemicals, but pipelines are somewhere around 5 to 10 times safer in terms of accidents per mile than our trains or trucks. Trains are safer than trucks, but we've seen what happened, and it could easily happen again. So I say two things. One, at a macro level, we need pipelines. We need them because they're the lowest cost and safest way to get oil and gas across the continent. And then secondly, the issues that are going on here are much broader. I do not agree, or I do not trust what was officially said to the residents of East Palestine, that it was safe to drink the water, that it was safe to resume life as normal. We know that a lot of these issues around water can take time to manifest. We saw what happened in Flint, Michigan, et cetera. It's a real tragedy, and I don't know that the residents of East Palestine are being told the full truth about the situation.
Well, you talk about blame shifting and taking responsibility, and it is interesting that we have had a reluctance, seemingly, from the Biden administration to really step up here. FEMA only agreed to send aid to East Palestine after refusing to do so for 2 weeks. President Biden hasn't paid a visit to the area, even though many are calling for him to show up and pay attention there. And Secretary of Transportation Pete Buttigieg, he is shifting the blame onto the railway company, saying that it's Norfolk Southern who need to be held accountable for this. Overall speaking, what do you make of the Biden administration's reaction to this calamity?
Oh, it's really unfortunate. It was such an easy win, but I think it goes to priorities, frankly. We seem to be willing to spend $100 billion to support the Ukrainian war efforts. We seem to be willing to take trips to Kiev to show our moral support, but not willing to show the same kind of support for our own citizens, whether it be along our southern border or in places that suffer tragedies like East Palestine.
And these are topics that you touch on in your book, Why America Matters, a case for a new exceptionalism, the focus on domestic issues. I know you break that down in tremendous detail in the book. I know you're also asserting that when it comes to government telling us the truth, that we're not necessarily getting the full or accurate story when it comes to Russia's invasion of Ukraine. So we're going to have to bring you back to break that down for us. But thank you again so much, Michael Wilkerson. Appreciate your insights.
Thank you, Michelle. Great to be with you.
All right. And thank you for watching Kitco. I'm Michelle Makori. Keep it right here for more.